We have P Minka PLC, a hyper-growing firm in Ghana, prepares its financial statement on 31st December. On 31st December 2021, PM issued share options to 7 of 8 senior executives, giving each executive the option to purchase 2 million shares at 6.5 per share. The fair value of each option at that date was 4 cedis. Exercise of the share option was conditional on the completion of 2 years service from 31st December 2021. Below the share price subsequent 2022 13.5, 2023 17.5. On 31st March 2023, after the 2022 financial statements were authorized for issue, PM's chief finance officer, one of the 7 executives, unexpectedly resigned from her position. On 30th April 2023, another executive, Mrs. Tosa, was dismissed. The 5 remaining executives exercised their option on 31st December 2023. In line with IFRS 2, share-based payment, recommend how the above scenario will have been dealt with in the financial statement. Clearly, you can see that this is what? Share option. Now, the company has 7 workers. The share they are giving to these workers are 2 million. Watch here, the executives, giving each executive the option to purchase 2 million shares at 6.50 pesos per share. So here you can underline this one, option to purchase. Have you seen this?
Yes.
You underline this option to purchase. It stands for something. This option to purchase stands for something. And also that the fair value. Have you seen that? The fair value at the date was what? It was 4 cedis. You understand? So when you understand this, and the rest are what? You can easily understand the rest. This is what they mean. This is the share option. They've given you the share option. They've also given you the fair value of what? Of 4 cedis. And they said the exercise of the share option was conditional on the what? On the completion of 2 years. This one too, you should understand this condition. See. So all these things we've already discussed them. And also when you come here, this is the company share price on subsequent date was as what follows: 2022, 2023. This is the share price in the subsequent years. On 31st March 2023, after 2022 financial statements were authorized for issue, PM Chief Finance Officer, one of 7 executives, unexpectedly resigned from her position. This statement is very important. This statement is very, very important. Which standard falls under it? Which standard falls under?
Sir, are you talking about the fair value or the service one?
No, I'm talking about this statement. This statement, there is a standard that guides adjusting and non-adjusting events. That's what I want you to draw your attention to.
Okay, 8.
Adjusting and non-adjusting event.
Subsequent event.
Before the issue of what, or the financial statement, something happened. Is it adjusting event or not adjusting event?
This is a non-adjusting event.
Why is it non-adjusting event? So this is which standard is that?
It's 8, sir.
No, this is not what do you call it? 8. It is not estimation, and then policy is under 8.
Then 10.
This is IAS 10. This IAS. So is this adjusting event or not adjusting event? You see, at what point do we say that this event is what is adjustable and this event is not adjustable? You understand? So if you already have an existing event before the end of the accounting year, when something happens, it's an adjusting event. Can't you see that? When did they make a decision to what? To give them the share options? 2021.
1.
Do you understand? If 2021 was when they made a decision to give them share option before the vesting period, something happens, and you want to tell me that it's not adjustable. You
No, we
understand?
have to.
Yeah.
No, the thing has occasion already.
Yeah, no, there's already an event.
An existing
There's
existing
already an existing event already on this
already.
matter.
Yeah.
You are it's just like you have receivables. You ask yourself, is this adjusting event or not? So you should take note of what. Take note of all this. Okay, so that is what happened. So the person resigned on 30th April 2023. Another executive, the person who resigned on 31st March 2023 after 2022 financial statements were authorized for issue. When did they, like, which year will that affect?
Then the issue affects the preceding year, the year before 2023. It should affect the preceding year, the year before 2023.
So on 31st March 2023, after the 2022 financial years were authorized, after the
For
2022 financial statements were authorized for issue, PM Chief Officer, one of the seven unexpectedly resigned. Then let us look at this one. The person resigned after the authorization. Can't you see that? I'm just analyzing the question here.
sure.
So the person resigned after the 2022 financial statements were authorized. So if the person, if they have already issued it after the what? After the authorization, then it will fall in the 2023.
Yeah,
On
because when
31st
you
March
issue,
2023, after the 2022 financial statements were authorized for issue. You see, this one is what? Is an IAS 10. So this is non-adjusting event because they have already issued the what?
the statement
The
or sign it.
statement. You understand? They've already signed and issued the statement before this happened. So there's no need for them to adjust the what? The financial state, the financials. So it should fall between January and March before the authorization. This one will fall within the new accounting year, 2023. On 30th, you see, at a point, some of the items can also be adjusted, even if it is what? It is issued and later recovered. If that event can gravely affect the financial statement, they can recall and then make adjustments because
Yeah.
before an account is what is issued for shareholders who have hold on it, it has gone through auditors' hands and all that. If the event that happened will not affect gravely to the financial statement, they will what?
So let it
They will
go.
defer it to the what? To the current
The
account year. But
following
when
year.
you look at this one, the vesting period is 2023. So it will
Yeah.
not affect the what? The financials because
Yes, sir.
the date has not expired yet because the vesting period is 2023. 2022 is what? Year 1 and 2023 is what? Year 2. So if it didn't happen in 2022, it can happen in 2023. And this one, it happened after the account is what? Is issued. There's no need for them to what? Adjust the financials because it will not have any effect on the what? On the face of the financials. Please are you with me?
Yes,
Okay.
sir.
All right. So that is it about that. And then on April 2023, another executive TOSA was dismissed. That's 2023. All right. So you take note of all this. So let us, recommend how the above scenario have been what dealt with in the financial statement of PM 2023. All right. So what is the name of the company?
P Manka.
Okay. So this is what equity settlement. So let us look at the elements in it. You have what? Share option. The share option is how much? 2 million. And then the employees. 7. Vesting period. What is the vesting period? What is the vesting period? The vesting period is how many years?
2 years.
2 years. All right. Now, in this one, they gave them what? Okay, what's the grant date? The grant date is when?
So that is December 2021.
Okay, so 31st December
2021.
2021. Okay. And they gave them also what? Exercise. They gave them exercise option. Have you seen it? Have you seen the
Yes, sir.
exercise option?
The exercise of the share option was conditional on the
SR's option is how
completion of
much? SR's option price is how much? They give them what? 6.5. And they give them fair value. Fair value at the
okay,
grant date.
okay.
Fair value
Fair value is 4.
at grant date is 4. So this is your question. And they also tell some people also left. We will look at that. So this is a summary of the question. And 2 people left their work. One was sacked. One left. Okay, so the period. Okay, so let's go in solution. So year 1 ends in what? 2023. So 31st December 2022. You have what? How many workers do you have?
We have 7, sir.
7 workers. Year 1, 2022, did somebody leave? When you read the question, did you see somebody leaving in 2022? I didn't see anybody leaving in 2022. They didn't state anything here. Being 2022.
There none.
Nobody left. Okay, then you multiply. What is the share option? They gave us 2 million, right? Have you seen it? Share option 2 million. Please, have you seen it? 2 million. Then you multiply by 2 here. If you fail, you can bring all the zeros. So let us hang 3 zeros. So you have 3 here. And the fair value at the grand date is how much? Fair value at the grand date is how much?
4.
4. You multiply by 4. When you are done, then you what? Then you weight it. This one gives me, it gives me 2,800. Okay. Then the last vesting or the vesting year, you have what? 7 people. And how many people left?
We have 2 persons. So
Okay, one was sacked and one left voluntarily. All right, so you multiply by what? Share option. Then you multiply by what? Grand date fair value. Then you multiply by what? 2 over 2. Okay, so this one gives me. Okay, so that is all that you have here. So when you're done, then you what? You can. So you will have your what? You have your what? Your equity. Here is 2,800. Here is 40,000. So this one is. Yeah, this one is 28,000, not 2,800. So here we'll give you 28,000.
and the other one is 40,000.
Yeah. So here you have your what? Your expenses. All right. So here we'll spend this all. Then here you'll find the difference between them. Okay. So that is it. So this one will give you about 12,000 here. All right. What next? So we are done here. Then you come and do your what? Your exercise option. Some people did that. So they say that the rest of the people who qualify exercise the option. That's what they said. All right. So how many employees in total? They were 7. And then how many left? You have 2. So you have 5 remain. So these people qualify. So if they qualify, then they can exercise their option. So they have 5 people. The option they give them, the exercise option is how much? What is the value? The exercise option. Have you seen it? Because have you seen it? Okay. Okay, so 6.5 is how much they are giving to them. And what is the share? The total share value is how much? They are giving them 2 million. So you have 5 multiplied by 6.5 times 2. So you have what? 65,000. So now the people who exercise the share option are going to what? They are going to what? Pay this money to what? To the company. Now, so this is what we have here. So we have the share option, 65,000, and the equity. The total final value for the equity for the final year is how much? 40,000. Have you seen it? So this
That's
one goes to equity. So that one is what? 40,000. All right. So when you are done, then you will come and do your journal entry. All right. So your journal entry, you have your debit here, and you have your credit here. So your cash or bank. First, your share option. You are receiving this 65,000 from what? From these people as what? As an income. Then you what? You credit, because when you sell shares to people, when you sell shares, it comes as what? So how much? 65,000. When you sell shares, you debit cash, then you credit what? Equity. Well, no, then you come and do the equity. That one too, you can add it to this one, or you can drop different words journal entry for it. If you like, I can add it. If you don't like to, I can draft different this thing. So let me draft different journal entry for the equity. So that one too, you have what? Debit, you have credit. So here you debit share option reserve. You debit the 40,000 there. Then you credit retained earnings. Yeah. Also what? 40,000. What does this mean? The second one, what does this mean? We have share option reserve. When you create equity, you understand? So if you want to reward members, giving them shares, you understand? So if you want to reward members, giving them shares, you create what we call share option reserve, right? You create something called share option reserve. So when you create share option reserve, then you credit that value in the share option reserve. Create that value, you create that account to hold onto the weighted shares as we did above there. Let's assume the final year estimation. So let's assume the final year estimation of 40,000 will remain in the books of the credit side, in the books of the company. When you finally settle the out with the beneficiary, then you need to debit it and remove it in from your books in that order. That is the meaning of what I just did here. So when you debit it, it will cancel it out from the book. Then it will go into what we call retained earnings. We are done with this question as well. If there's no question, so that is it about that.